any tips on managing this once personal limits in each state have been reached? Obviously, chatting with your accountant is probably a good first step. This is just general advice, but then you do have trust structures that can sometimes help, with individual circumstances. So it's obviously something that, we can't avoid. It is what it is. Queensland have recently changed their land tax legislation, making it less favourable for us as investors. It's still very viable. It's still, a strong, one of the strongest options in terms of a state, and it might continue to change in the future. That's probably more of a state level concept. Federal government, very pro-property. State level, they're not really pro anything. They're just pro-taxes and gathering money for their coffers. So, they generally act independently from federal governments. The tips would probably be having a chat to an accountant and then looking at purchasing in different structures to necessarily avoid land tax considerations. That would be how you could navigate it. It's not specific advice there, Joseph, but it is just general. It's something that has been successful for myself and others in the past.